look at the data, we've already exceeded the peak in terms of the GDP numbers, kind of the big overall number in terms of home prices, or of economic activity. We've exceeded the job number peak at this point, so we're ahead on that count. So we've, in a data sense, exceeded where we were at the start of the last recession. So we're over and above that at this point. And I guess to kind of cut to the chase, the expectation is we're going to keep moving forward at a moderate pace beyond that. And as a couple of the last slides will show some of the particular numbers in terms of the forecast for those of you who like the numbers. But we're ahead of where we were at the last peak, and we're moving forward beyond that, and in some cases by a fairly significant amount. You point out a fact that in addition to the number of people who are employed, what are they earning? And that, of course, goes into whether or not households feel like they have the income to purchase a home. The academic answer is that it's tied to productivity. As we all collectively get more productive in whatever we do, we should see that reflected in our wages. The more productive we are, the more we're producing whatever we're producing, whether it's widgets or some type of other service or activity. If we're more productive doing that, our wages should reflect that. But what we haven't seen, and you point out a very interesting wrinkle in all of this, is that wages just have not been rising very fast. And at least to this point, there's been a lot of folks scratching their head over that, because you saw the number of people employed, and the good news there is in the economy, you would think wages would start to pick up, but they just haven't. So I think a couple factors that are holding back wages at this point is some uncertainty in the economy about whether the good times, and I put that in quotes, good times we've seen so far will last and continue. Employers are reluctant to commit to hiring too many more new people, and given that there's still quite a few people who are unemployed, there's a lot of people out there in many areas who are willing and able to come in and take any open job, so there's no reason to raise wages to attract folks. The one exception to that area, maybe there's more than one, but the one exception that's probably notable to mention now is in the construction industry. We've heard from many different sources that one of the things holding back construction is there just aren't enough qualified people in the various construction trades. So it's not necessarily a matter of paying bricklayers and drywall people more. There just aren't as many people with those types of skills out there to do those kinds of jobs as there was a few years ago. Maybe that's also similar in other types of industries as well. So there is an ongoing discussion about what is happening in the wage side, simply because, as you point out, we would hope to see and expect to see that the number of people earning a higher wage as we go forward would actually be increasing, and wages would be increasing, and that would certainly be another positive here that we are not seeing. NAR has not done any original work in that area in terms of gauging how many first-time buyers incorrectly think they couldn't qualify for a mortgage. There have been other studies, I'm not sure who, perhaps done by Fannie Mae or Freddie Mac, but there is a significant portion of that 59% who are incorrect in their assessment. They actually could qualify for a mortgage with the, through FHA or other programs as well at this point. But as you know, looking at just the headlines in the news media, sometimes that gives an overly pessimistic view about what it takes to buy a home, leaving people the assumption that you necessarily need 20% down and all those other factors that for the typical first-time buyer thinking about buying a home, that just seems like too big a hurdle to overcome. I think we had that 83% who would like to be homeowners at some point in the future. I can't put a specific number on it except to say I would probably say a majority of them. The issue here is when they're going to be a valid prospect, meaning it may be that they're not able to qualify for a mortgage or go forward with a home purchase for 2 years. They still want to buy a home, but when they will be qualified, when they will feel comfortable taking on that financial requirement of having a mortgage and so forth is the question I really don't have a good sense of. But in terms of those who would be open to purchasing a home today and then in the immediate term, I think that's going to be growing, partly because, as we saw earlier, that picture about rent increases, it's not only increasing at a stable rate of 2 or 3% a year, it's increasing at an increasing rate. So there's more and more renters who I think are going to reevaluate the value of renting versus owning each time they get a lease renewal from their landlord, and rents have increased 8-10% from what they were the previous year. Regulation certainly plays a role. I mean, there's no doubt of that. We've had, Consumer Financial Protection Bureau has promulgated some regulation and so forth, especially in the mortgage side. But from the kind of the bigger picture, macro picture, I think we have to keep in mind that this recovery, we've been in a recovery now, officially now for several years, has been much slower than we anticipated. But it is largely kind of the nature of where we were and what it takes to kind of bounce back from that in terms of not just the financial aspect that I mentioned before, but if you think about it, all of us experienced the recession and recovery in a number of different ways. Even if you or a member of your family didn't find yourself as part of the foreclosure statistics, all of us probably took a hit to our value of our homes. Probably not a devastating hit, but it was something that we felt personally. So I think, and you look at data on consumer confidence and how they think about where we're at in terms of the recovery, 40% of Americans still think we're in recession based on one survey. So there's a lot of psychology involved here and how consumers are viewing their personal financial situation that's also holding back the recovery, in addition to things like regulation and some of the other hurdles we've talked about as well. But that statistic that I've tracked now for several months, again, as I said, roughly 40% of Americans still think we're in a recession. And this is not about the specific definition of how a recession is defined by the economists. This is just their sense, do you think we're in a recession? And 4 in 10 Americans still think we are. Part of that is a very practical application. That's where we have the data. And that's where data collection started in a consistent way where we can make those comparisons. So that's the kind of the data answer. But you're very much correct in that things have changed a lot, and we can see that even over the last decade or more about how various aspects of the economy have changed beyond what we would have ever imagined. But I guess that's one of the shortcomings that economists face, is we have to compare it to something, and there's very few things that we can compare it to. We've only had a handful of recessions since World War II. So what's typical? Well, we have to kind of go back to the data and decide what's typical based on the information we have. But of course, keeping an open mind that today is a lot different than it was, 1960 and certainly 1940. Some things are very consistent in terms of what we saw in 2000 versus what we saw more recently and so forth. But there are certainly other factors in the economy that we probably don't fully understand in terms of how they're affecting the way we do business, not just in real estate, but just the way the economy does business in terms of communication technology, for example, the ease of conducting transactions both online and elsewhere. All of those types of things we've come to take for granted on a day-to-day basis. There's a lot of smart people thinking about those kinds of things to see how they're affecting, either in a positive way or a negative way, the economy over the last several years. And there's no clear answer on that, except we could probably all agree that things have evolved and changed enough that today is not like it was 15 or 20 years ago. But that's kind of no consensus on how those additional factors that we're all aware of might be influencing what we expect in terms of the ups and downs of the housing market or the economy overall. this is a question about the comment I made earlier about falling prices now, and deflation and why we have that kind of 2% threshold. The idea is that 2% is sufficiently above zero. We can go up and down a little bit around it and not cause any difficulty. So the question is, why are prices that go down, not just low inflation, but prices that actually decline, why is that a problem? And the reason is that it basically pulls the life out of the entire economy in many ways. One example is if you know that something is going to be cheaper 6 months from now than it is today, I'm not necessarily talking about just technology, but we're talking, say cars. If you're in a declining price environment, you know that the car I could buy today is going to be $3,000 less expensive, same car, 6 months from now. Are you going to buy the car today, or are you going to wait 6 months? Most people would probably want to wait 6 months to save $3,000. But 6 months from now, that same car, or even a newer model, is going to be $2,500 cheaper because prices are declining. Are you going to buy the car, or are you going to wait another 6 months? So that's what I mean by a spiral. And one example you can see of that is, to the extent that you have followed anything going on in Japan over the last decade, they've been very much in that cycle. Now they're headed into their next recession, never having gotten any real significant growth. The idea is that it's very hard to pull the economy out of a downward price spiral, because what do you do to convince people that you need to buy something today because prices are going to be higher 6 months from now, when all someone has seen is prices declining for the last year, for example. So it's a very hard thing from a policy perspective to change. Yeah, one of the things in any of the national price data, NAR's data or any other source of data, is you have to be careful kind of what the mix of homes is in that price, that price number that's being reflected there. What we saw several years ago when there was a lot of distressed properties on the market, of course they sell for below market value in most cases, so that was tending to push down price gains relative to what they would have been otherwise. Virtually all of those distressed homes are out of the market, so we're getting more consistent mix of homes in the data that's being reflected in those prices now. So you're right, you have to be aware of that. However, at the national level or even a metro level, it's really less about the precise number of 4.5% growth versus 4.3 than it is really the relative trends and the path that's on. Yeah, we do a separate survey of vacation and investment home buyers. And one of the things that we've seen on the vacation side, as opposed to the investment side, is that home prices have eased over the last year or two, and it's very much tied to what's going on in the stock market. Because a big majority of vacation homes are purchased for cash. Certainly a vacation home is not a necessity versus a luxury, so it really depends on what vacation home buyers are feeling today in terms of their financial situation, whether or not they want to commit to buying a vacation home or want to invest in a vacation home by paying all cash. So it's a very discretionary purchase. So the vacation home side is very much tied to what's going on in the economy in the here and now versus some of the longer term trends we talked about of the desire to own a home at some point in the future, and those lifestyle considerations that are less important in the vacation side than it might be for the primary residence buyer. It's good to keep in mind that there's only one interest rate that the Fed has any influence on. That's a very short-term rate that we saw the chart, and it's basically been zero now for several years. So what else affects mortgage rates? Well, the overall inflation rate. So we're in a low inflation environment, so that's been one of the factors that's held down mortgage rates, because if you want to get your get your money back at some point in the future, it depends on what you anticipate the inflation rate is going to be, and so that'll influence the interest rate that you're charging someone who's borrowing money from you. There is the world economy, in the sense that if one area of the world, say in this case Europe, which you've seen, is suffering, and other parts of the world are suffering, that means maybe the U.S. will become a more desirable investment location, which will make assets in the U.S. more valuable, and that will tend to support interest rates domestically. And there's the other aspects of the economy you talked about in terms of what the anticipation is for growth, even apart from inflation. So there's a long list of things that could potentially affect interest rates, but inflation, the international situation, and kind of the overall economy are probably the three most important ones, over and above what the Fed may decide to do with short-term interest rates. I think the one area that has been consistently missed, if you will, in terms of forecasting going forward, is what's going to be the future path of interest rates. As the economy started to pick up, we regained the jobs we lost, growth was moving along. The anticipation was, yeah, I mean, things are moving along. Of course, the Fed is going to start raising interest rates at some point. The name of the survey is Home Ownership and Market Experience Survey, so HOME, Home Survey. And so this is the first time that NAR has done a consistent, or will be doing a consistent survey of consumers overall. So the goal is to get a sense of what consumers out there are thinking in terms of the current real estate market, kind of sentiment, as well as use it as a sounding board if there is any particular policy question that would be relevant to a large group of homeowners to get their feedback on. So that'll be coming in December 15th. We also, part of our research group has a large number of infographics that take a lot of this information and put it into kind of bite-sized nuggets you can use on your social media, you can use in any kind of presentation. Go to realtor.org and the research area, and if you can't find it, certainly contact me specifically and I can put you in touch with that as well. So there's a number of new sources of information that can make available. Certainly those infographics that we do are very popular, and a lot of folks have used those to good effect, and so I'd urge you to take a look at those. Again, all free for your use, however you'd like to use them.